Bitcoin futures have become a significant force in shaping the behavior of trading markets since their introduction, influencing price discovery, volatility, and overall market dynamics in ways that go far beyond the crypto ecosystem. By allowing traders and institutional investors to speculate on the future price of Bitcoin without holding the actual asset, Bitcoin futures provide a regulated and accessible gateway for participation in crypto markets. This accessibility has brought in traditional market players, such as hedge funds and asset managers, who previously avoided the crypto space due to concerns about custody and regulatory clarity. Their participation has contributed to deeper liquidity and higher volumes in Bitcoin-related trading, which in turn impacts spot prices because futures markets often lead price discovery in other asset classes. As large futures contracts are executed, especially on platforms like the CME, they can cause ripple effects in the spot market due to arbitrage strategies that keep futures and spot prices aligned. For example, when Bitcoin futures trade at a premium to spot prices, traders may buy Bitcoin on the spot market and sell futures contracts to capture the difference, creating upward pressure on spot prices. Conversely, if futures trade at a discount, the reverse may occur, leading to selling in spot markets. Furthermore, the existence of futures has allowed investors to short Bitcoin easily, which introduces downward pressure in times of bearish sentiment and contributes to increased volatility. This ability to hedge or bet against Bitcoin has changed the nature of market swings, as futures enable amplified reactions to macroeconomic news, regulatory developments, or large-scale liquidations. Bitcoin futures also affect funding rates and leverage in the perpetual futures markets offered by crypto exchanges, which are closely tied to trader positioning. When the futures market becomes heavily skewed toward long or short positions, it can set the stage for cascading liquidations that send prices moving violently in one direction. Institutional involvement via futures also ties Bitcoin more closely to traditional financial markets, exposing it to broader risk-off events. For instance, during times of global market stress, institutions managing Bitcoin futures positions might unwind them alongside equities or commodities, increasing correlations and reducing Bitcoin's role as an uncorrelated asset. In addition, the launch of Bitcoin futures ETFs has made exposure to Bitcoin even easier for retail investors, increasing inflows but also amplifying volatility as ETF creations and redemptions influence futures demand. These ETFs can distort futures pricing when they roll over contracts near expiry, creating pressure on specific expiry dates and contributing to short-term volatility spikes. Altogether, Bitcoin futures have transformed how Bitcoin trades, making it a more mature asset class, but also subjecting it to new complexities and risks. As futures volumes continue to grow, they will remain a key driver of sentiment and price movements in both crypto and broader financial markets, cementing their role as a powerful tool that shapes trading behavior globally.